Hello, comrades. Welcome to this session on assets. So, we've already discussed why inflation is such, it can creep up on you, right? And in order to fight against inflation, in order to help your money not go down in your purchasing power, assets is that defense. Correct. So today let us look at the different assets and let us see what it is that what are the different types of assets and what are the special qualities of these assets. So the first one being equity. So you would have heard equity a lot, right? Equity, invest in equity, I have this much money in equity. So what is equity exactly? Equity basically means owning a portion of an entity or a business. Correct. So when you own equity, you basically own a business or a portion of a business. So the percentages differ. Correct. So when you buy a stock, right, you're basically buying a portion of the business. Correct. So there are like a set number of stocks, and then if you purchase one, you become a part owner of the business, and that's how you need to think when you're in equity. Right. Not all of us have the caliber or the qualities to start a business, but all of us can definitely own a business through the stock market. And where can you buy a stock? It's through an exchange. Correct. The exchange is a place where stocks can be the exchange of stocks can be facilitated, right? So you have a buyer and a seller. Generally, the buyer, so from where to get the stocks, it's when the company itself gives sells the stock onto the stock market through an IPO, which is an initial public offering. So when a company comes out with an initial public offering, it's basically telling, hey guys, we have these many shares, are you interested to own a part of our company? Correct. And so then they float the shares into the market, and whoever is interested can purchase it at the price decided by the company itself through certain valuations, right? And they'll have their own metrics. So based on their different liabilities and whatever there is, so they'll come up with a valuation, and then you could definitely go and purchase a business. So that is what equity is. Basically, you own a portion of a business or you own the whole business. Correct. So the listing of the IPO generally is seen by the regulatory authority. In India, it is Securities Exchange Board of India. In US, it's the Securities Exchange Commission. So there are different regulatory boards in different exchanges all over the world, right? So I hope you got a little bit more clarity on what is equity. I'll repeat myself again for the interest of you understanding the concept. Is equity is basically when you own a portion of a business. Correct. One way of owning equity is stocks, right? And we've seen how companies come to the market through an initial public offering, and the public can purchase the shares at the evaluations the company claims they are worth. So once you want to buy a stocks or a share in the stock exchange, you definitely you need to have an account, and then you account in an exchange. And then, for example, in India, you have the National Stock Exchange or the Bombay Stock Exchange. In London, you've got the London Stock Exchange, the New York Stock Exchange. So basically, all countries have these stock exchanges where the companies listed. What do I mean by listed? That means basically they've come out with an IPO, they've issued shares, there's free float into the market, and whoever's interested to own a part of the business or whoever's interested to be a part owner of the business can definitely purchase shares and be the part owner of the business. Right? This is very interesting concept. So now let us come to pricing. Right, so ITC, Indian Tobacco Company, one share of theirs is approximately worth 240 rupees. Whereas there's another company which manufactures tires called the Madras Rubber Factory, and their shares is approximately worth 74,000 rupees. So one of the most expensive stocks in the world, one of the most expensive shares in the world. Correct. So ITC's stock or ITC as a company is more valuable. The stock is more expensive compared to MRF. And why do I say this? We'll get to it on another video. But just remember, the price which you're seeing on the stock exchange might not necessarily be the actual price. So as I've explained IPO, so there's a valuation which is given by a firm, and then the company agrees with it, disagrees with it, they have some discussion, then they go to the regulatory authority saying that, hey, we want to list. So then SEBI, in case of India, will go through the documents, will see everything and give a green light. And once you get the green signal, you'll have a date slated, and then you could participate in the IPO. And public can basically own a part of your business, right? So this is what basically equity, one type of owning equity is through the stock exchange, through the stock market, through shares. And how do you get these shares, I've explained, and basically evaluations and all of that. I will go into the into detail of it. And just remember one thing, ITC, which is worth 200 rupees, is less expensive than 30 more than 30 times priced MRF. And we'll get into what is the reason for this. Next type of owning equity is through venture capitalists, or basically through these funds. So what is a venture capitalist? A venture capitalist basically, as the name basically suggests, there's a venture and these people fund that venture through huge sums of money. Correct. So now, as I told you, so to get into a venture capitalist, right? So, but the best part about this is they fund the startup or the business at a very young stage, or a very early stage. And what does this enable? So this does enable, if the company grows on to be very big, right? At an early stage, the valuation might not be very big. Correct, because they do not have a proper business which is pumped, which is generating money and revenue. So at the early stage, the valuation might not be very high. So this works in the favor of a venture capitalist, because he can get a higher stake, a higher equity in the business, so that when the business goes higher, his equity or his shares also swell up and grow in value. Correct. So and there are multiple stages of funding. Correct. So they have A, B, C series. So whenever you read, say, a particular startup got this much funding in this series, right? So basically the multiple series. So as and when a startup says, okay, I require some more money to run my business, to grow my business, they go to a venture capitalist, and they have multiple series of rounds. So the first series will definitely be A series, and then consequent series will be named after different the consequent alphabets. Correct. So definitely capital involved over here is very, very high. Correct. So if you want to participate in like venture capitalists, the capital is very high. Although nowadays a lot more venture capitalists are coming out with funds wherein you yourself can put some of your own hard-earned money into the fund, and then it can think. But since this is early stage, right, there's very, very high risk. Why do I mean that? So almost 90% of the startups fail. Correct. So early stage does have a lot of merits, but there are multiple demerits as well, which we need to be aware of. Correct. So basically you're taking on more risk to earn more reward, right? See, if you come at later stage, right, what will happen is, yes, everyone will be aware of, everyone's eyes will be on this company or this business, and they'll understand what it is, so they'll be willing to pay higher rupees or dollars for it. Correct. But at a younger stage, at an earlier stage, not many people's focus or attention is on this firm. So that is why venture capitalist is highly risky, but yeah, the upside is immense, right? Is almost infinite. Correct. Accessibility is low. Correct. So if you have enough money, startups will come to you. But if you don't, your access to these high quality startups, or startups which will actually go on to make a lot of money, will be limited. So that is why it's less accessible. So your stock market, anyone can open, if provided you have the right documents, anyone can open an account and start trading in stocks. But venture capitalists, not only is it highly risky, but it is also less accessible compared to, say, a stock market. So now we've covered two types of equity. The first one being stocks and equity, stocks and shares. The second one being venture capitalists. Now let us come to another interesting thing called angel investing. correct? So angel investing is, again, so try to break down the etymology of the word, right? Angel, so basically meaning someone who's helping you. So even before the firms go to venture capitalists, they come to angel investing, or also called as the friends and family round. So basically they'll go and ask their own friends and family for funding, because again, so once you go to venture capitalists, right, you'll have to show metrics, right? You have to show your viability of the business, correct? So sometimes that might not be clear until you start, right? And until you do a market survey, you might have to do it before you even start, but still the feasibility of your products and how they work in the market might not be clear to you. So that's the reason, before even you go to a venture capitalist, right, angel investing is a preferred route, because once you're going to angel investing, you get access to equity. I mean, you get access, the firm gets access to money, and the person giving the money gets access to a small portion of the equity, correct? Another advantage of going to, say, a venture capitalist than angel investing is venture capitalists do mentor you, because these are seasoned professionals sitting on the board of the venture, these are seasoned professionals, right? So they know exactly how a business has to be run, what is the runway to profitability, right? What are the products, how do you find a market fit? So all of this is known by a venture capitalist, whereas for an angel investing is basically common folks like you and I, who are basically supporting their relative or their friend in a new business venture, correct? So basically it's also called seed funding, again. So try to break down the word, it's seed. So basically when it's a seed is the smallest, what you say, the youngest form, if that's the right word, of a plant, correct? So when you seed funding, you're basically making sure that you are supporting the venture or the business at the smallest stage, at the youngest stage, correct? So yeah, so seed funding, and you'll get a portion of the company, correct? Same thing. So that is what equity is, right? As I told you, equity is basically when you own a portion of a business or an entity. Again, accessibility is very, very low. How many people you know from your own circle of network who started a startup, and not only started a startup, has asked money from you, correct? So accessibility is very, very low, and especially it's lower than even venture capitalists. Venture capitalists, you can at least contribute to a fund of a venture capitalist, but angel investing is is less accessible, high risk again, right? So the upside is amazing, but there's also a lot of risk, right? When a startup, you might not have visibility of how successful it's going to be, right? The reason you gave the money is because you thought it's successful, but you're not sure, right? You're betting on the fact, correct? And again, high reward, so immense reward if you are successful and the fund started, which you seed funded, or which you given some amount, it's successful. High capital as well. Again, capital might vary, but again, if you want a bigger portion of the pie, definitely you need to give more capital. Another interesting aspect of owning equity is through ESOPs, employee stock options. So one of the richest people in the world, I think in the top 50, is Steve Ballmer. And Steve Ballmer is one of the only people, I think is the only person in the top 100 people, richest people in the world on Forbes list, who's not started a company, nor does he have any stocks in other company. His riches only came through Microsoft stock, which Bill Gates had given it to him since he was an early employee, and he was a CEO also from early 2000s till Satya Nadella took over. So ESOPs also are a very, very interesting option to gain access to equity or to own equity, and a lot of new startups are starting nowadays. So if you are working in a startup, definitely inquire about ESOPs. So basically employee stock options are also given to executives. Why? Because once you're an executive, if he performs well, the company grows in business, right? So that is why when you have your skin in the game, right? When you've given, like when you have you've given, like when you own equity or you own a portion of the business, it is your business now. So you want to make sure your business thrives so that your money grows and your investment grows. So that is why employee stock options, or even executives, so even if it's an old company or a big conglomerate, right, your employees are given stocks so that they have their own interest in the same interest of the company. Correct. So these are the different instruments, I would say, of equity.